On to geopolitical concerns, the US-China trade war, of course, affecting emerging markets around the world and currencies. Are we actually going to see some recovery as we end the year off?
It's been a tough year for emerging market economies because there's been that contingent that started because of that trade war, and a lot of countries suffering because of that, and the geopolitical news that have been coming through from the US mostly, and recently Saudi Arabia. We've seen a lot of tiffs as well between Turkey and the US, and that's hurt a lot of emerging market currencies. And today I had an opportunity to speak to Jameel Ahmad, and he says emerging markets could get out of this, but also there are some risks going forward.
As a contagion when you look at market factors. For example, the currency weakness in the Turkish lira at the end of the summer, the way that encouraged currency weakness throughout global emerging markets was quite spectacular. So that's what we call contagion factor. In terms of whether they can recover, yes, emerging markets always recover, but there's unfavorable market conditions, specifically around political risk, which is something investors are really nervous about because it's something that you can't predict. And then on top of this, you've got a stronger dollar. Stronger dollar weighs on emerging markets. Again, another reason why the South African rand is very weak. And until those conditions become more favorable, it's difficult to say where there's light at the end of the tunnel for the emerging markets. This trend could continue into the end of 2018 at least.
Let's speak a little more about those currencies. We saw some movement lower for the rand as well as the Turkish lira. It also weakened as well. We saw some movement as well for the rupee, but there are other emerging market currencies that are still fighting off this whole contingent that you're speaking about. How come are the other markets doing far better than South Africa and the likes of Russia and Turkey as well?
It's a great question. Actually, if you look at the global emerging market basket in 2018, the Mexican peso stands alone as the only currency to have strengthened against the US dollar. However, some currencies have been hit more than others. For example, the South African rand, Turkish lira, Russian ruble, Brazilian real. These are currencies that belong to markets with weak currency account deficits. So basically, to put in simple terms, they have weaker financial and fiscal positions than the likes of Thailand, Malaysia, China. Those are examples of currencies that have not weakened as heavily in these uncertain times in comparison to the likes of the lira and the rand. What we've seen is a lot of market volatility. Now, what we do expect from emerging markets is that they will begin to print lower GDP growth than 2 or 3 years ago. So they will enter a period of weakness when it comes to economic output, but this economic output is still stronger than what we would have seen before the financial crisis.
What should these kind of markets do to fall in line and kind of cushion themselves from all these developments that are happening economically and geopolitically?
They can encourage some more domestic stimulus and look at more domestic policy. However, it's mainly external market conditions that have contributed to the huge weakness. So until there really is a breakthrough with US-China trade tensions or less political risk on the geopolitical front, and also with some of the other elements of political risk, the investor sentiment will remain so that investors are not so attracted towards emerging markets.
We've seen that in terms of the forecast and the growth forecast, emerging markets far surpass developed markets. Is this something investors still looking into as a matter of interest?
Absolutely, and that's why we say there's still a divergence between economic growth in the emerging markets and in the developed world. Now, continuing into the developed world a little bit more, we only see the United States as the economy that's really above the pack. You've got US interest rates that are rising, US Federal Reserve are very upbeat, that's the central bank of the United States, and US economic growth is consistently outperforming expectations. But Europe, Japan, United Kingdom, these are examples of developed markets that are not showing those levels of consistencies. And this is where emerging markets can come into play, because in comparison to those developed markets, emerging market growth is still far superior.
When we look at South Africa, just to bring it home, we've had a change in the finance minister as well, and change in leadership in terms of the presidency. Has there been talks amongst investors about these changes and how they can affect the rand going forward?
Yeah, over the near term. So we saw some movements in the South African rand when some of these domestic political changes happened. But the major contributor and influencer between market developments is really what's going on in the global markets, external uncertainties. That's the major reason behind why the South African rand has depreciated up to 15% this year. It's not that anything's happening politically or domestically. It's not something that's idiosyncratic to South Africa or isolated. Emerging markets of similar natures have all suffered during very external and uncertain times.
We've seen a very protectionist approach coming from the U.S. Can emerging markets protect themselves from that kind of approach by trading amongst themselves more between, say, Turkey and South Africa and China as well, just to try and bring more money to their markets instead of just relying on Western powers to do that?
This is another big risk for global financial markets, is that protectionist narrative that President Trump really adopts and he's shown signs towards embracing. That's why investors are very reluctant towards investing in the emerging markets, because emerging markets are reliant on global trade. They're very much still developing, so global trade's very important to all emerging markets.
And just my last question, from the turmoil that we've seen throughout the year, do you see an amicable end to this emerging market downtime, as well as the trade war that's currently happening?
Unfortunately, a lot of the political risk is very unpredictable. So one thing we can do is predict politics, and that's why investors are very nervous and maintain a very cautious stance. US markets are also selling off today. We've seen a lot of sell-offs in global emerging markets, Asian market, European markets, and United States over the past 2 weeks. But there are two potential catalysts that investors can look for to really start embracing some more risk appetite, which is either selling the US dollar, which means the Trump administration talking more downbeat about dollar strength, because it's something that President Trump does not want, or a breakthrough in US-China trade tensions. The problem with this is that nobody knows when it could occur. Nobody wants a trade war, but likewise nobody knows where the resolution is either.